This is your LMAX exchange technical update for Monday, June 26, 2017. Euro dollar. So the euro has been showing signs of a potential top over the past several sessions, but while the market holds above 111.10, the overall pressure remains on the top side and there is risk for a more immediate push to fresh 2017 highs and towards the August 2016 peak at 113.67 further up. If we do see a breakdown below 111.10, that will trigger the onset of a correction that could take the market back towards 109.25, but at that point a higher low would be sought out in favor of a continuation of gains, ultimately back up towards that 114 to 117 critical longer term resistance zone. Only back below 108.40 would ultimately force a shift in the structure. So overall the pressure remains on the top side, and the question right now is just whether the continuation of gains happens more quickly or if we break down below 111.10 and it exposes a correction towards the 109.25 area. Sterling dollar. So cable has seen a pullback below that previous range resistance at 127.75 that had capped gains for so many months off the plus 30-year low in October of 2016 at 118.40. The breakout above 127.75 in April was critical and sets the stage for a more meaningful recovery back towards a measured move extension in the 135 area over the coming weeks. And so while we have seen a pullback below 27.75, it is only viewed as corrective. There is risk that we see additional declines towards 124.50, but again corrective, with the market now seeing a more significant structural shift in the works and for upside favor towards next key meaningful resistance at 135. Only back below 123.60 would really delay this outlook, but again it looks like the market is putting in a significant base here, longer term base, following that break above 127.75, and setbacks from here should be very well supported around the 24.50 area. Dollar yen. So dollar yen has seen a nice little bounce out from those 2017 lows, but overall the pressure here remains on the downside while the market holds below 114.37. We could see a break back above 112.13, which would take the more immediate pressure off the downside, but again overall the downtrend here remains intact and there is risk for a resumption of declines to retest the 2017 low just shy of 108. Ultimately again only back above 114.37 would force a shift in the structure. Euro Swiss. So Euro Swiss continues to be very well capped ahead of a critical psychological barrier at 110, which also acts as a level that will define whether the market remains in a downtrend or sees a more significant structural shift favoring the top side. While it holds below 110, there is risk for resumption of declines and the downtrend remains intact for a retest of critical support now in the 106s ahead of 106. Aussie dollar. So Aussie has been very well capped in recent rallies above 76. We've seen resistance in the 76 area going back earlier this year into April, and so the market could once again be in the process of rolling over for a resumption of declines back towards the recent lows that we saw in 2017 around the 73.30 area. It would take a break above 76, a close above 76, to put the pressure on the top side and expose a move up towards more critical medium to longer term resistance in the 78 area. But again, while the market holds below 76 on a close basis, there is risk for a continuation of declines. Dollar CAD. So dollar CAD has seen some setbacks since the 2017 high that was seen just shy of 138 back in early May, but overall here the broader uptrend remains intact and there is risk for the market to bottom out over the coming sessions in favor of a resumption of these gains. A break back above recent resistance, which comes in around 33.50, will strengthen this outlook, and any setbacks that we do see from here should be very well supported ahead of and above on a close basis that 130 psychological barrier. Only below 130 would give reason for reconsideration. Kiwi dollar. So the New Zealand dollar has come up over the past several days from those 2017 lows, making a significant recovery, a very healthy recovery, but overall this is a market that continues to show signs of topping out, being very well capped into rallies above the 72 handle, and so there is risk that this rally once again stalls out in favor of a bearish resumption. But we would need to see a breakdown below 71.85 to strengthen this outlook and accelerate declines, but ultimately any rallies that we do see should continue to be very well capped ahead of 74. SPX 500. So the S&P 500 continues to put in its record run, trading up to fresh record highs now well above 2,400. This latest break that we saw, this breakout that we saw several weeks back has set the stage for this extension potentially up towards the 2480 area, and at this point the market would need to see a breakdown below 2400 at a minimum to take the immediate pressure off the top side, while a break back below 2320 is what will be required to force a meaningful structural shift. Until then, the pressure remains on the top side and the focus is on an extension towards that 2480 target. Gold. So gold continues to be a very constructive chart over the past several months, putting in a series of higher lows and higher highs. And so this latest setback that we've seen off that 2017 high at 1296 is considered corrective, with the market ideally putting in the next higher low in favor of a bullish resumption above 1296 and towards the 2016 peak at 1375 further up. So if we do see any more setbacks this week, expect them to be supported ideally ahead of 1230, and only a breakdown back below that previous higher low that was seen, that confirmed higher low on the 9th of May around 1214, would compromise the constructive outlook for gold.